Welcome. My name is Jeff Russell, and I'm the CEO of Delta Dental of Iowa. This is an exciting time for the healthcare industry as we prepare for healthcare reform, changing the way people purchase and access healthcare benefits. While many of the reforms impact medical insurance, there are significant implications for dental insurance, such as the requirement for pediatric dental benefits. We're pleased our lawmakers recognize the importance of dental care and improving access for Iowa's children. As Iowa's largest and most experienced dental benefits carrier, Delta Dental is proud to support ABI and its members to identify the information you need to make informed healthcare decisions. Thank you and enjoy the day.
Tax partner at Bergen Paulson. He is a tax expert leading their firm-wide tax department. His expertise has been developed through extensive experience in tax preparation and planning, small business consulting and tax research in the healthcare and real estate development and holdings industries. Mitch is a member of the Cedar Rapids Estate Planning Council, Centerpoint Lions Group, the First United Methodist Church in Marion, and originally from Lamont, Iowa. He attended UNI and received his BA in accounting. And then Alice Helly, who I think has a copy of the bill on her nightstand and reads it in her spare time. So Alice is always full of new information when it comes to healthcare reform. She's a member of Brown Winnick, and she practices in the area of employee benefits and adoption law. She's been selected for inclusion in the best lawyers in America in the area of employee benefits law annually for more than 10 years. And we've got her on the circuit, so you will see her often. She received her BS degree from Iowa State University, her law degree from Drake, and was executive editor of the Drake Law Review and a member of the Order of the Coif. So congratulations on that. And Sean Yolish, who is with Merit Resources. Merit Resources is a professional employment organization, and they actually take the HR burden off of companies like ABI, and we're happy to be a client of theirs. He joined Merit in 2007 as the Vice President of Benefits, oversees all employee benefits for Merit clients as well as corporate HR for Merit. He's worked in the PEO industry since 1996, working in the areas of HR, employee benefits, payroll administration, product development, legal compliance, project management, corporate governance, process management, risk management, and others. He's led several areas as well, including managing all employee benefits and internal corporate communication. Yeah, I could go on, but I don't need to. We're going to stop it right there. The bottom line is we're here to answer your questions, so we're going to start with these guys sort of just giving an overview, but then from there, please feel free to chime in and ask the questions so this can be as valuable as it can to you. Sean, take it away.
All right, I'll just start by saying Alice and I have done these a number of times. Like Lisa said, this is Mitch's first addition to the roadshow, and I want to welcome Mitch to the band, if you will. He promised to bring a horn, although I don't see it anywhere. We do have a presentation. I think all of you have copies of the presentation as well. We have found, Alice and I, historically, that while we can go through the presentation, there's usually a lot of questions in a lot of different areas. And while we're happy to actually walk through the presentation and go through the presentation format, I wanted to open it up and at least just see where people want to be on those bullet points there. If there's any particular area that anybody would really like us to hone in on, maybe we can start by doing that so we can give as much time as we can to some of the questions that you may have. With all the changes that have happened in the last couple of weeks with the postponement of the penalties regarding on the employer mandate, or even how to count full-time employees, small business tax credit, any of those things, is there any burning desire in any area? I wanted to open it up to that and that we can focus on, or we can start walking right through the presentation. That is an option, I think, for you guys, because we're here to help you.
I think we'll start if you want to, and then chime in as questions arise.
Am I right with that? Yep. So, Alice, I'll let you start with the key coverage requirements.
Thanks, Sean. Trying to tie Mitch up with this cord here. Can I have the thank you. Okay, probably you've seen all of these before, but there are some key coverage requirements in the bill. Some of them kicked in immediately in 2010, and others are becoming effective as we go. beginning next year, and these have not been postponed. Very few things in the bill were postponed, so that's the biggest area of confusion right now, what's still effective and what's not. For all plans, whether or not they're grandfathered, there will be no lifetime limits on essential health benefits beginning next year. There are restricted annual limits on essential health benefits. That's no less than $2 million this year and no limit next year. Dependent benefits for adult children up to age 26, that's already in effect. Except for grandfathered plans, they didn't have to cover them if they had coverage elsewhere. That will change next year. So next year, a grandfathered plan has to cover the dependents, even if they do have an option elsewhere, if they want to be under the parent's plan. Do we have any grandfathered plans in the room? Anybody still have a grandfathered plan? Is there? Okay. There are currently no pre-existing condition limitations for children under 19. Beginning next year, no pre-existing condition limitations for anybody. And beginning next year, waiting periods cannot be longer than 90 days. And it's important to know that that's 90 days, it's not 3 months. So if your plan says 3 months now, you're going to need to tweak that. Certain other requirements are for non-grandfathered plans only, which sounds like is everybody in the room. No cost sharing for immunizations and preventative care. There's an internal and external review process required for denied claims. That didn't have a big impact in Iowa because what the insurance department already required pretty much met the federal requirements. I don't know if you saw it. I didn't see any impact in Iowa with that at all. And coverage will be required for clinical trials. And then I'll turn it over to any questions about any of those. Ran through that really quickly.
Are most of the union plans, are they grandfathered in?
No.
Like, I'm from the Waterloo area, and John Deere, their employees they have a 7-month probationary period.
Right.
So does that mean that starting in 2014, they can't have a 7-month waiting period, probationary period?
Right. Yeah, the only way plans are grandfathered, union or otherwise, is that they have had essentially no changes since 2010. You know, they can have increases in contributions as the total premium goes up, but they're just within certain required, certain fairly restrictive limits. And otherwise, if they've had any significant changes, they're not grandfathered, and union plans are not automatically grandfathered, so that will affect them.
Yeah, I would say, I would add to that, I don't think that with the 90-day waiting period, I don't think that that's affected whether you're grandfathered or not grandfathered, regardless, if you will. So beginning next year in 2014, and it doesn't matter what size of a group you are, whether you're a small group or a large group, they're going to have to start doing enrollments 90 days after the person becomes eligible. And Alice is going to talk a little bit later about how do you define who's eligible. Those of you out there, and probably all of you out there, probably do your benefit enrollments on the first, to be effective the first of whatever month. Traditionally, small businesses, and all the small businesses I've dealt with, a vast majority do the first of the month following 90 days. That won't be compliant any longer because you'll be beyond 90 days to go out to the first of the month. So a lot of small businesses are going to have to change their policy, not unlike John Deere going from 7 months, but certainly down to a probably 60 days and first of the month following that.
Because that was a competitive advantage for the small manufacturers to compete against Deere, their benefits.
Right, because they offered their benefits earlier,
Right.
which was a richer benefit for someone who was a new hire. The question was posed to me this morning, I'm digressing a little bit and I apologize, why would a small employer continue to offer benefits? And whether, one of the key reasons to offer benefits, some business owners think it's their moral obligation to do that. But really a true business reason would be to be an employer of choice for employees. Now, employees might be able to go and, if there is no employer mandate, or for a small business, they can go to the exchange, they might be able to get subsidies or whatnot. But how does that change the dynamic of the labor market when you have labor out there who's looking to go work for someone who they think is going to be the best employer to work for? So it's going to change the dynamic in how you seek talent, but no one's been able to predict. I haven't even seen any prediction of what that's going to do to the labor force yet. And read a lot about HR stuff, if you will, and I haven't seen any predictions yet on how that's going to change that market dynamic. Again, I digress, sorry. So what do small groups have to do? So if you're a small group between 2 and 50 in Iowa, it'll be 1 to 50 come January 1st. They did amend the law to say a group of 1 to 50. I'm not sure how you get to a group of 1. Doesn't mean my definition of group, but that doesn't count anyways. But you have to have essential health benefits. And the essential health benefits, I'm not going to read through them all there. They're primarily benefits that are typically offered under most health plans, so this isn't really unusual. And Iowa actually picked a health plan that's sold in the marketplace. It actually is a Wellmark health plan, if I have it up there yet, and you probably can't see it because I'm sitting in front of it. It's a Wellmark Alliance Select Copay Plus plan. So that is their benchmark plan that they're using and saying these are the types of coverages that need to be available within a specific health plan. I emphasize again, in the small group market that has to have these essential health benefits. Another key change is the deductibles. It's a $2,000 maximum deductible now in the small group marketplace. Before, you could have any size deductible. You could have a high deductible health plan. You could use HSAs, HRAs. That's gone. It's a $2,000 deductible for individuals, $4,000 for family. Max deductibles in the small group marketplace, whether you're buying in the exchange or not in the exchange. The other one is the out-of-pocket limits. It just did raise recently with HRA limits for 2014. They are $6,350 and $12,700 for families. So that's the out-of-pocket maximum that someone can have come out of pocket. So co-pays, deductibles, co-insurance, all of those things tied together, excluding premiums, can't exceed that amount for an employee in the course of a year on a group plan. Any questions on the small group side?
Well, is that true for, are there any non-covered expenses that that a person would receive, whether it be experimental care or whatever it might be, and do those apply to the out-of-pocket?
One of the things, and I think I had it up there on the previous one. Oh, you know where it is. That's all right. There is some coverage, I think, for some trial testing. But what might not be covered, to answer your question more specifically, is elective surgeries. Those still won't be covered. So if someone wants to get their nose fixed or something like that, unless there's a medical necessity, it still wouldn't be covered.
And not only not covered, but they don't apply to the maximum.
Correct. They would not apply to the maximum at all. Yes, sir.
A lot of small employers over the last several years have used medical savings account plans in order to encourage more cost-conscious decision-making by employees at the time of purchase. What happens to the concept of MSAs under the Essential Health Benefits package? Are we still going to see MSAs offered in the marketplace or emphasized?
I might defer to Mitch on this because Archer medical savings accounts are not something that I typically deal with. I will partially answer the question and see if Mitch has any thoughts that the HSAs and the HRAs will still be out there. They'll still be used. I don't know how heavily because it's, $2,000 is about what, in my opinion, a deductible ought to be. So I don't know how much more traction you're going to get by having them pay a portion of it when $2,000 on a $200,000 bill is really not meaningful in the scheme of things. But it does help defray some of the costs. Mitch, I don't know if you have any thoughts on the medical.
Yeah, unfortunately, I don't have a whole lot to add other than what you said. Like Sean said, I don't know that you'll see them being as applicable as maybe they have been in the past or pushed as heavily as they have in the past, just because the fact that, what is the real benefit when you're really talking $2,000 or $4,000 versus what you would pay out of pocket for medical savings plan. So I guess I kind of foresee them being pushed maybe a little less, but I guess time will tell with what's going to happen.
And markets are different throughout the country. In Iowa, a $2,000 or even a $5,000 qualified high deductible health plan is not uncommon. That would be uncommon in the Northeast Coast, where I'm not even sure they've adopted any kind of qualified health plans yet because they're very rich in the Northeast Coast as far as the type of plans that they offer. But I'm anticipating to see some change. Large group is where you see them more frequently, though, too, because particularly in self-insured environments. And I still think you're going to see those. And there's not the deductible limitation as you'll note up here on the slide now, there's a whole different, to be a qualified health plan in a large group side, greater than 50 employees, is different than that small group side where you have to have the essential health benefits. And those are the terms that they use, the essential health benefits or qualified health plan. On the large side, it's based on actuarial value. I'm not an actuary, I'd be lying if I even pretended to be one. So I'm gonna try to explain it in the simplest terms that I understand what actuarial value means. If we were the entire population in this room and we're getting health care and we were insured, the maximum on average that any one of us would be paying would be 40%. Again, not any one of us, the average would be 40% of the cost. And the insurance would be picking up 60% of the cost. It doesn't mean that on an individual basis, they're looking really at a population and whether it meets actuarial value or not. And there's even some debate amongst actuaries whether Uncle Sam is really doing it based on an actuarial basis or not, but that's neither here nor there. I can pretty much ensure that anybody who's offering a plan out there to the large group marketplace is just a question you should ask your broker or the carrier themselves. Is this going to meet those requirements? There are calculators out there that the DOL has that you can run it through, but like any other calculator, it's looking for specific answers to specific questions to plug in, and not every plan ties to those questions, if that makes sense. So it's not easy to just go out and use the calculator, but that is the off-the-cuff answer that the Department of Labor and HHS are going to give. Is you just got to go use their calculator and see. The other chain difference is that 60% actuarial value is not a difference, but it applies to those items there. Co-insurance, deductibles, co-payments are all applied in that actuarial value analysis. There is no essential health benefits, but there are core health benefits that have to be covered. And I've itemized those there. They're really broad general areas of coverage, typical major medical coverage. Now they've codified this at the federal level, but I would tell you that it's not a dramatic change to what you might have in a major medical health plan. While there's no deductible limitations on the large group plans, there is out-of-pocket maximums, and they're the same as in the small group market. Both in the small group and in the large group, they're subject to change year to year with HRA, HSA limits. Any other questions on the large group?
So the short answer is self-funded large group employers still have substantially more discretion in how to structure their plans than the small group market has.
Yes. Yep. Whether they're self-insured or not, they can at least work even under a fully insured
Even
environment.
fully insured, the large group has
Yep.
more discretion.
Far more discretion. Now, out-of-pocket maximum though really hurts. As far as trying to do a high deductible health plan or something like that, you still can't get as creative as maybe you might want to. I'll pass it back to Alice.
Thanks, John. The law also provided for medical loss ratio rebates. And basically, beginning in 2011, health insurers are required to spend a minimum percentage of premium dollars on claims and related things. And for the large group market, that's 50 plus, it's 85%. For the small group market, it's 80%. Insurers, I guess, refer to those as medical losses. When they pay a claim, that's a loss. So if their medical loss ratio does not fall within these limits, they have to pay a rebate. And the first rebates were due by August 1st of last year, and we're about to have the second round. Does anybody in here get a medical loss rebate?
One of my clients did.
Okay, yeah, it sounds like Sean's company's about to get one. I know Wellmark didn't have any. They met the requirements, and they're the biggest insurer in Iowa, so we haven't seen a lot of these. But if you get one, sorry, I didn't advance the slide. If you get one of these, you need to be careful. You can't just automatically deposit it in the company's account because to the extent that this was paid attributable to employee payments, they're plan assets. So let's say, just to make it simple, you pay half the premium, your employees pay half the premium, you get a $10,000 medical loss rebate. $5,000 of that is going to be plan assets. The other $5,000 you can do whatever you want with. There are various things that you can do with these, including just giving it back in cash to the employees that pay the premiums, which in a lot of cases might be the easiest thing to do. You can also use it to enhance benefits. There are fairly specific things that you can do with it. But this might sound kind of familiar. Several years ago, Principal, Prudential, some other large insurers that were mutual companies demutualized, and paid checks out to their policyholders. And some of those went back years and years. I know we had a few plans that, the plan had been gone or the employees had been gone forever, but this is a similar concept, and what you do with the check is similar to that. You have to figure out what's plan assets and then what you can do with it. So be careful with those if you do receive them.